Welcome to this screencast on an introduction to partnerships and their financial statements. Now, you already know a bit about partnerships from your AS studies, but this screencast will build on that knowledge and introduce the financial statements of a partnership business that will be assessed in ACN 3. So what are we going to cover here? Well, we're going to look first of all at the differences between sole traders and partnerships. That will be followed by the partnership agreement and its role in the business. Then we'll look at the financial statements of a partnership, and in particular the appropriation account, and then we'll look at an example of the appropriation account which you can follow on the presentation, and there'll be some exercises for you to attempt after that. So what is a partnership? Well, the Partnership Act of 1890 defines a partnership as two or more persons carrying on a business with a view to profit. Now, partners have unlimited liability in the same way as sole traders do. Therefore, they can have their own private assets taken away to pay for the debts of the business. So if that's a similarity, what are the differences between a sole trader and a partnership? Well, with a sole trader, there is only one owner. And because there's only one owner, all the profit belongs to that one owner. And the decisions are made by that owner. There's going to be no risk of disagreement at all. But over here with a partnership, there are two or more owners. Business studies textbooks say between 2 and 20, but in reality there can be many more than 20 partners. That profit therefore has to be shared between the partners, and we'll look at how that's done a little bit later. And in order to make decisions, the partners need to reach an agreement, and therefore there may be a higher risk of disagreement and discussion that's necessary to reach those decisions than would be the case for a sole trader. When it comes to finance, because it's a small business with only one owner, only small amounts of finance are available to a sole trader. That is the money, the capital that the sole trader can put in himself or herself, plus any money that they can borrow. Whereas with a partnership, because there are more owners, more money can go into the business's capital, each partner bringing some capital of their own, and therefore there's more finance available to the business. But also because the size of the business is more valuable, the assets are more valuable, it means that a bank is likely to lend more money to a partnership business than it would to a sole trader, because there's more security, there's more collateral, the assets are there to be sold off in case the business doesn't pay back the loan. And then finally, what happens if everything goes pear-shaped? Well, the risk of failure and the liability for that failure in a sole trader business lies purely on the shoulders of that one owner, whereas in a partnership business, it's going to be shared. And so each partner will bear much less than they would do than if it were a sole trader business. Now, the role of the partnership agreement is next. The partnership agreement is a written document outlining the rules of the partnership to ensure they're clear to all the partners. And this is done to minimize the risk of arguments and disagreements amongst the partners. And the partners can have anything they want in their partnership agreement. It's their rules, it's their business, they can have whatever they want. But some of the things that they could have are shown here. Firstly, the amount of capital that's going to be invested by each partner, so everyone knows how much needs to be put in. Secondly, the rate of interest they're going to be given as a return for their investment. So if they put money in, they're going to want some return on that, just as you would if you put your money in the bank. Thirdly, the rate of interest to be charged on drawings in order to discourage one partner taking more out than the others, leaving no profit left for the others. They will have to pay back more in interest on drawings as a sort of recompense to the others. And then the next one, amount of salaries to be given to the partners. If the partner has a particular role or job within the partnership, extra responsibility for example, then this means they should see a little bit more of the profit as a return on that. And then lastly, the way in which the final profit or loss left over, what we call the residual profits, are going to be shared between the partners. But what happens if there is no partnership agreement? The partners don't have to have a partnership agreement. It's not in the law to say they have to. It's up to them whether they want it or not. But if they choose not to, then the Partnership Act of 1890 comes into force. Firstly, profits and losses are going to be shared equally. So you can't have it any other way than the same amount each. And then finally, the loans made by partners to the partnership business. For example, if a partner leaves the partnership, they may not be able to take all their capital with them. There might not be enough money in the bank of the business to pay them, and so they might leave some of the money that they're owed as a loan that will be repaid over 4 or 5 years, something like that. Well, if they do that, then the Partnership Act says that loan will attract interest at 5% per annum, 5% per year. And you can see that if that's all the Partnership Act says, then you can't have any salaries, you can't have any interest on capital, and you can't have an interest on drawings to discourage anyone from taking more out than the others. So if the partners want those things, then they have to create a partnership agreement with those things in it. Now let's look at the financial statements of a partnership. You're already familiar with the income statement and with the balance sheet. We've done all of those for a sole trader and also for a limited company. We'll deal with the capital and current accounts in another presentation. So for today, I want to concentrate on the appropriation account. Now, the appropriation account is the account that is used to share out those profits and losses between the partners. We've seen a sole trader, all of the profit goes to them, all of the loss is borne by them, but in a partnership we have to share it out. And that's what appropriation means. It means sharing out. So this sharing out account follows straight on at the end of the income statement, after the profit or loss for the year. So where we would have stopped for a sole trader with the profit or loss for the year is where the appropriation account starts off. Now we're going to have a look at an example of an appropriation account. You'll see this example in your notes in the pack that goes along with this presentation. We'll just have a look at this now. We've got Posh and Bex as partners in their business. They've made a profit for the year ended 31st of December of £120,000. Posh has contributed capital of £150,000, but Bex has risked a bit more, £200,000 into the business. Both partners have taken out £50,000 in drawings from the business during the year to live on, and they've decided that any profits or losses at the end, the residual profits and losses, they'll be shared equally. Interest on capital is going to be given to the partners at 5%, so whoever risks more capital will get more of the profit back. And to discourage one from taking more than the other, they've got interest on drawings, which is going to be charged to the partners at 5% per annum. Beckham receives a salary for £15,000 for additional duties. He's got extra responsibility in the business and is going to see more of the profit as a result of that. And finally, the balances on the current accounts are currently £70,000 for Posh and £80,000 for Bex. Now, we're not going to see that in the appropriation account today, but it will become relevant when we look at the current accounts in a future presentation. So here's our appropriation account with the profit for the year. This is at the end of the income statement. So we've done the sales less the cost of sales, add any other income less the expenses, and we've arrived at a profit for the year of £120,000. Now that needs to be shared out in some way between the partners. But before we get to share it out, remember that the partners have got to be penalised for taking out too much as drawings during the year. You'll see they've agreed that they will individually be charged 5% on their drawings. So Posh has taken out £50,000 on her drawings during the year, and Bex has taken the same amount. And so the business is going to receive back from them 5% of those figures as extra income. So the partners are paying that back into the business, which means extra income for the partnership business, and therefore the profit for the business has gone up to £125,000. And it's that profit figure that we're now going to share out between the partners in the way they've agreed in their partnership agreement. Now the first way we're going to share it out is to share out more to the person who risked more capital. You'll remember Posh invested £150,000 of capital, but Bex had risked more, £200,000, and therefore they're going to receive 5% back on that, in the same way they would receive interest if they put it into their bank account. So Posh is going to receive £7,500 of profit, whereas Bex is going to receive £10,000. And that means that the first £17,500 of that £125,000 profit we saw just at the top there has now been shared out. And that leaves us with £107,500 that we're still going to share out in whichever way they've agreed to do it. And the next way they've agreed to do it is by giving more to the person who has more responsibility. So Bex, remember, had extra work to do, extra job in the partnership business, and they'd agreed he'd receive a salary of £15,000. Now, it doesn't mean to say that he's actually taking £15,000 in cash out of the business every month. What it means is that he's going to receive more of the profit than Posh would. So that's £15,000 of the profit for the year, which is going to be allocated to Bex as a result of this extra responsibility. And that leaves what we call the residual profits, the profit that we still need to share out of £92,500. And the partnership have agreed that we're going to share that amount out equally. And so the balance of the profit at the end means that that £92,500 is shared half to Posh, half to Bex, which means they're going to receive £46,250 each, on top of what they may have already received further up in the appropriation account. And it's always a good idea to add those two figures at the end, just in case there are any rounding errors. Make sure you come back to the same figure that you started with here, the £92,500, so that you know that you shared all the profit out correctly. So that's the end of the appropriation account, and I'd like you to practice this by having a go at the questions in the pack on this topic. We'll be doing some more in class, and then we'll build the effect of these items into the partner's current accounts that will then appear in the balance sheet. Thanks for watching.